Hey there, this is Jacob Wood with Douglas Elliman Real Estate. If you're like most of my clients, you'd like some more information on the effect that the Federal Reserve's decision this week to raise interest rates 3/4 of a point is likely to have on the New York City real estate market. Now, typically, New York City is more resilient to rising interest rates than the rest of the country for several reasons. One, nearly half of our buyers here are cash buyers, which is a bulwark against rising rates we have that the rest of the country doesn't. Two, if you're the average U.S. buyer, you're spending about $375K on a home. You're putting down 5–10% on an FHA loan. Your loan-to-value ratio is high, and you're spending a higher percentage of your income on your monthly outlay. You're going to be very interest rate conscious and very conscious of your overall monthly cost. If it raises much, you're likely not going to be able to afford to do your deal. Whereas in New York City, our average purchase price is 1.9. The average buyer is taking out a jumbo loan, which has lower rates, if they're financing at all. If they're buying in a co-op, and there's a 60% chance they are, then they're putting down at least 20%, likely more, which means they have a lower loan-to-value ratio, and they're spending disproportionately less of their monthly income on their housing cost. And so if their cost goes up, that monthly affordability is not as big a deal for them. They're looking mainly for value. And so for those reasons, we tend to be more resistant to rising rates than the rest of the country. Now, what is going to matter going forward are expert mortgage bankers who have flexible products. Over the past few years, any rate savings getting an adjustable rate product really wasn't worth the effort. Whereas now, conventional rates are at 6.25, whereas a 7/10/1 ARM is at 4.75. If you put down 30%, they're at 4.5. If you're a jumbo borrower, your 30-year fixed is at 5.5, and your ARMs are a point lower than that. And so there's considerable savings getting a 7/10/1 ARM. If you're a 1-bedroom, 2-bedroom buyer, and you know for a fact you're not going to be in the home for too much longer than 10 years, there's significant savings for you there. Even if you stay that 11th year after the rate adjusts, you're likely to save money over the course of the next 10 years with rates being what they are. It's also important for the banker to offer attractive rate locks. I wouldn't be surprised to see rates at 8% by the end of the year. We're going to see more action by the Fed, we're likely to anyway, by the end of the year. A 60–90-day rate lock is going to be attractive for buyers. Now, if you're a buyer, you're likely to have more buying power now than at the end of the year. And if you are pausing for some sort of market correction, people looking for a market correction in New York City real estate tend to be disappointed. We haven't seen the increase in supply, the decrease in activity that typically precedes a price correction. And while prices might stagnate, I wouldn't count on them lowering between now and the end of the year. This is certainly the case for 6-figure price points. If you're a seller and you're looking to upgrade, you might be able to afford to take your time, especially if you have a lot of equity in your home, and so you'll therefore be taking out a smaller mortgage on your purchase. But if you are selling to take the cash, your buyer pool is likely to have a good bit more buying power now than the end of the year. And while no one can tell the future and a severe price correction isn't anticipated, it is unlikely that the environment will be more favorable to sellers 3 months from now, 6 months from now, than it is now. If you have more specific questions about how the current environment is affecting your situation personally, feel free to reach out to me anytime. This is Jacob Wood with Douglas Elliman Real Estate.